Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending August 12th, 2022. I'm Preston Brent. Thanks for tuning in. This week's theme has really been kind of resonating with us and our members for the past 2 or 3 weeks, where I've been telling folks it's time to buy the dip. Any pullback here is worth buying for the near term. We'll go into the charts in just 1 minute, but let's just kind of take a look at where we've been over this past week. We've actually have rallied 4 weeks in a row. Okay, we've been up, which is really nice because the markets look like they were tumbling down even more in June, but we've been having a nice little rally here. In fact, um, this past week, inflation came in while it was still elevated, it started to slow. So some market participants are interpreting this as peak inflation. And it's supporting the view that the Feds may not be as aggressive in their September rate hike, although I believe they're still going to do probably 75 basis points. The markets has backed off of that and probably sitting around 50 basis points right now. The big debate is all around interest rates, though, right? It's whether the rally that we've just seen is over, this 4 week rally. And there are skeptics out there that say inflation isn't really contained, primarily due to labor pressures, and the Feds are going to be will continue to lift most of their short-term rates fairly aggressively. If we look at the Fed Fund futures, what they're showing is that inflation is going to peak by year, or the interest rates, the terminal rate by the Feds, is going to peak the end of the year, 3.5% to 3.75%. Now, keep in mind we're at about 2.5 right now, so that would make it another 100 to 125 basis point hike. Okay, so if we say the Feds raise rates 75 basis points in September, and then two more meetings in November and December where they're hiking 25 basis points each, that would put us at that 3.75% end of year forecast. So the markets are being a little bit more optimistic. The Feds are sounding more pessimistic. One of them's going to end up right, one's going to end up wrong. We'll see how it plays out. But meanwhile, we've had a nice 4 week rally. If we look at the chart here, you can see everybody this week was solidly in the green. We're still in a correction territory by most, except for the Dow. It's only down a little over 7% year to date. You can see the best sector for the week was energy, worst was staples, which is considered a value play. Growth has been doing fairly well over the past 4 weeks. You can see annually, energy is still leading the way. In fact, from the first week on this entire year, energy's led the way to the upside. Communication services is leading the way to the downside year to date. Valuations and volatility, if we look at this, you can see the PE ratio on a forward basis, 12-month forward, is a little over 18.6, 18.7. And you can see the dividend yield in the S&P sitting at 154, 10-year treasury at 2.85. So the 10-year treasury is about 131 bips higher than the dividend yield. Okay, and you can see the earnings yield of the S&P is about 4.8% roughly, which if you look at it, the yield in the S&P over the 10-year is about 1.94%. However, if you throw inflation in, it's a minus 3.71%. So the Feds clearly need to bring inflation down more. All right, the current VIX closed out the week, believe it or not, below 20. First time we've had a close below 20 for the week in quite some time. Typically, we've seen the VIX, when it gets down around that 20 area, it wants to go higher. So we've got to be very careful here. Last week, the VIX closed at 21.15. So it was down a little over 7.5% for the week. Okay. So if we come over and just take a look at the headline inflation this past week, which kind of got the ball rolling earlier in the week, we saw that it did come down to 8.5% from 9.1 the prior month. And we did see the PPI, the producer price index, it fell 50 basis points too, to 9.8% in July. So we're seeing both CPI and PPI data coming down a little bit, but it's still very high, folks. So just understand that. And the Feds have reiterated again that they want to get inflation down. That's why I think they're going to do 75 basis point hike in about 3 or 4 weeks versus 50. And then, of course, if we jump over to Europe, they're announcing emergency funds to their economy sucks over there. They're probably going to be in a strong recession coming up towards the end of this year, early next year. They're having huge energy problems as well. Although we did see their industrial production rise for the third consecutive month in June. But UK, their GDP shrank 60 basis points compared to the previous month. Consensus forecast was calling for a 1.3% contraction. So we only had 60 basis point contraction. Okay. So we're going to see, I think the Bank of England is calling for recession in Britain by the end of this year. So all of Europe is suffering much more so than the US, especially in the energy side where they have been tied into Russian energy. And now their energy costs are through the roof as they're trying to find alternative supplies and suppliers for energy all across Europe. Meanwhile, in Japan, inflation is a big priority for their cabinet and their prime minister, Kishida. They're still in the stimulus mode. He said they're going to take whatever actions they need to do on fiscal spending without hesitation to respond to anything going on over there. So they're in this no man's land as far as Japan goes. In China, they're reporting a record trade surplus of a little over 101 billion in July. So as they start to open up, more and more Americans and Europeans are buying stuff that's made in China. So it's their trade surplus is doing fairly well. Air exports rose stronger than expected, over 18% from a year ago. Now they're opening back up, and they were a lot closed last year. So some of these numbers are really out of whack and skewed just a little bit. We did see their CPI rise 2.7% in July from a year earlier, and their PPI gained 4.2%. So I think China's got a lot of problems, primarily in the real estate sector, which that's attributable for more than 30 or 40% of all the wealth all across China. And they're having major issues with it. So I think that is going to be something that we need to pay close attention to. I don't think it's going to wash ashore in the US or Europe, but if it starts affecting other industry segments in China, then it will start to affect our markets, I believe. Now, if we come over and look at the E-mini S&P 500 futures, let me just get that on the screen for you guys. It'll take a couple of seconds to paint on your screen. But if we look at it, we've crossed a major milestone. I'll show you what I mean when the chart comes up on the screen. You can see this yellow line coming down. That's a 200 EMA. You can see we hit it, and then we stuck to it. And then Friday, we had that big breakout move. In fact, we moved up over 42.80. Huge breakout move. So we did get some follow through here. And if we look at volume, you can see volume is moving up, right? Volume has been relatively strong on this move higher, okay? So that's something that I want to watch and see where we go. I do believe it's going to be very difficult for the markets to get up much higher than this near term, leading up to the next Fed meeting. So for the next 4 weeks, in fact, I do believe after a 4-week run, we are subject to sideways to slightly downside action. Now, if you were to ask me where is the support area, then obvious answer to that is going to be the 200 EMA sitting at 42.15. Which is right above the 4,200 psychological number. So this is where I'm going to be watching for support. But it's been a nice run, really nice run in this. And now if we look at NASDAQ, NASDAQ also is sitting right on their 200 EMA. All right, now NASDAQ was down almost 34%. They hit their lows on June 16th. And then we had this double test on the 50 EMA. We had nice follow through. Then we sat for a while, and now we're sitting just right on the 200 EMA. I do believe it's going to have a little bit of a harder time getting through that area. We'll probably see it pull back some before it makes another run in the area. Now, I'm looking for a little bit of weakness next week, maybe in the next couple of weeks, and then another attempted run. And then I think as we go through the end of September into October, we're going to have a little bit more of a pullback. Have the lows been made this year? Hard to say right now. It depends on where the Feds are going to want to go, and it depends. Remember, we just had one data point on inflation through the CPI and PPI this past month. We're going to need two or three to tell us over the next 6 months how aggressive are the Feds going to be in hiking rates. That in turn is going to tell us where we either made the low or we got a lower low to go. Right now, the markets are telling me that we can make a lower low sometime in the next 3 to 6 months, okay, which would put us into Q1 of next year. If we look at the Russell, which had one of the strongest weeks of the indexes, you can see here it did get lift over the 200 EMA. That's a good sign because the Russell has traditionally been kind of a risk on type of asset class, so small cap. So when you see this run like this, that's a good thing, okay? And then, of course, if we look at the Dow, which has traditionally this year been one of the strongest indexes to hold up, you can see here we also moved over the 200 EMA. So NASDAQ, which wouldn't surprise me, is going to have a little bit more trouble getting lift because it's made a good run. And now the PE ratios of most tech stocks are elevated again. Okay, money has just flown in there. And there's probably been a short squeeze along with this run to kind of move this higher and extend it further and longer than it probably is warranted. So I believe a little bit of a softening in tech shares is probably going to be in the order over the next week or two. If we come down and look at volatility, as I said, it closed below 20 for the first time in a long time. You can see we're now down in this yellow zone. If I were to back it out, the last time we closed down here was in March, end of March. And then we sat down here for a little bit, and then away we went. Now you can see this steady move lower. So markets have been, since we hit those lows in the middle of June, steadily volatility's bled off. When you get a situation like this, what we normally see is a couple of scare the children moments where it zooms back up again, steadies, and then pulls back. So we're going to watch vol really closely. And then, of course, if we look at the bond market, interest rates are coming down, right? You can see here our interest rates going up rather. The bond market is rolling over. I think the bonds have one final move higher and rates lower. I think in 2023, interest rates are going to move a little bit lower. Bonds are going to move a little bit higher, seeking safety because the markets are going to be unsettled in 2023. All right, there's a big lag in what the Feds have done, especially with the interest rates and the quantitative tightening that they're going to have to pull on the U.S. balance sheet. And there's like a 6-month, 9-month lag. And we've got an inverted yield curve. So that typically pushes us out 9 months to a year to see uglier inflation. All right. So that's a little bit about what I'm seeing in the bond market and in interest rates. As I said, if we look at this, you're going to see where rates or just slightly below the 50 EMA. We had this nice little pullback here. My original target for the rates was 3.3. It's going to move up a little bit, I think, because the Feds are probably going to be a little bit more aggressive than the markets are anticipating for rate hikes. And then, of course, if we look at the dollar, well, Europe is so ugly right now. Which is the dollar is going to be strong just because the euro is going to be weak. Now, we fell through the 50 EMA. We didn't over here, but we did right here, but it's regained no follow through. So we're going to be chopping here. I think the dollar is more than likely to go higher because I just see Europe more recessionary bound than the U.S. at this point in time. So it could be fairly ugly. And then, of course, if we come down here and look at gold, well, gold is really, if you look at the chart here, it's just going to find trouble at the 200 EMA. We're sandwiched between the red line and the yellow line, which is the red line's the 50, the 200 EMA is the yellow line, and we're just slightly in the red for the year. You can see the closing price for 2021. So I think it's going to run sideways here. It's going to have a hard time getting north of 1880, that prior pivot high right there. It's going to have a hard time doing it. I'm going to go long precious metals, primarily silver, but now's not the time. And of course, if we look at silver, it had a strong Friday as well, much stronger than gold. You can see here, though, it's still well off the 200 EMA. So in many respects, silver got hurt a little bit more from a charting perspective, and well below the 2021 closing price. I think it's more apt to make a little bit faster run than gold. So if I had to play any of these, it would be silver. I'm not ready to play either of them right now. And then, of course, if we look at oil, down a little bit on Friday. You can see here how it's coming back up and testing the 200 EMA. I think it's going to run chop for a while. My target had been around the middle 80s, around 85. We actually got down to about 87. I think once it gets down around here, it's going to not go that much lower. We're still in the green for the year, but I think it's the odds favorite to run up just a little bit more on oil. And then nat gas, as you guys know, I've been telling you guys here in our free weekend roundup that nat gas, you want to be long. Okay, I've been long in this thing. I'd like to see it run up a little bit higher. As the winter approaches, Europe is going to be hurting, and we're going to be shipping as much natural gas as we can over to Europe. So that's going to help us here, but it's going to keep nat gas prices higher for our utility bills as well. Rather than us using nat gas, they're going to sit in over there and get, double and triple the money that we're charging here for natural gas. So it's going to stay elevated, guys. That's a little bit about what is the reason why I'm playing nat gas the way I am. All right, everybody, members, I will see you this Sunday evening. We've got a couple of stocks to look at and some other, a little bit more detail to go through in the earnings and just kind of where I see markets running. So far, we've had a great year. We're making money, really good money, well out above the market performance for sure, because it's all in the red. If you're not a member, I highly encourage you to come in and check us out. We're having a lot of fun this year. Next year it promises to be even wilder and give us even better opportunities. All right, everybody, have a really great weekend. Members, I will see you this Sunday evening for our weekly market watch. Take care, folks. Ciao now.